the next piece that we're going to be covering from the CMHC report here, Dan, which is
Yeah, this next segment is risks and vulnerabilities in the housing finance system. And so they start off by talking about mortgage delinquency rates. The mortgage delinquency rate continued to rise from historic low levels in 2024. And now, you'll often hear like mortgage delinquencies are up 40% or, like double digits of percents, but it reached 0.19%. So 19 basis points in the second quarter. So, like a fraction of a percent of mortgages are going delinquent. And allowances for expected credit losses both suggest that they expect this to continue through 2025. And there's a couple of really good charts on both of those, especially the allowance for credit losses in with certain types of loans, like really illustrates when they have the delinquency rates, but then losses relative to outstanding debt, and it's kind of just been rising at a relatively steady clip. And so I don't think that this is over by any means. It's like, we obviously still are below pre-pandemic levels, and probably the more important comparable is we're well below averages from the 1990s. Now, I will say it's definitely a different lending environment than it was then, where banks are really giving people a lot to help make sure that if they're in a financial stress, that they can kind of get out of it. So I think that it makes sense to me that they're well below the averages of the 1990s.
Yeah, I mean, I'd hope so as well. And more specifically on more mortgage delinquency rates, we're seeing a gradual uptick from what were historical low levels, and there are a few key factors at play here, Dan. What would some of them be?
Yeah, so the report shows that while delinquency rates are still relatively low, they're obviously on the rise. And as of June 2024, the overall mortgage delinquency rate stood, it was up about like 3 basis points to 0.17% from 0.14%.
Yeah, so incremental differences here. But what was driving those increases?
Yeah, so the two main factors that they outline were higher borrowing costs and elevated household debt. And when you look at the delinquencies by type of loan, it kind of starts to tell a bit more of a story. So they have like a chart that shows delinquency rates increasing for all credit products. And then that, so you imagine, okay, every house has this, like, let's call it a capital stack, or this like bundle of debt that they use. And this chart shows auto, credit card, and credit card. Like auto just had this spike up from Q1 to Q2. Credit cards kind of been slowly grinding up. Lines of credit, same thing, like less delinquency than credit card, but grinding up. Mortgage and HELOC, pretty flat, but they're slowly kind of creeping up. But like if you go down the lines in that chart, the order in which people would go delinquent on those loans is probably the lines, right? Like somebody's maybe they'd go credit card before car because you need your car to get to work and stuff like that, but who knows? Maybe the credit card, not really, because the minimum payment's much smaller, whereas like an auto loan's a pretty big payment on a monthly basis. And then again, you'd stop paying your line of credit, your mortgage, and then your HELOC. And so it's that whole pile of household debt. With interest rates climbing, many homeowners are facing larger mortgage payments, which can strain their budgets. The same thing is true for credit card payments, for lines of credit. These are all on floating rates, auto loans, etc. So you add that to the high levels of household debt that we're seeing across Canada, and this is where that financial stress really starts to pile up.
Yeah, it's important to note that this increase is concerning. We're still well below the delinquency rates that we saw during previous economic downturns. So for some context here, during the 2008-2009 global financial crisis, delinquency rates peaked at around 0.45%. So, we were at 0.14% in 2023. Now we're at 0.17%. Still a while away from that 0.45% of the greatest financial disaster that hopefully most of us will ever experience in our lifetime.
Yeah, I mean, the GFC wasn't really that bad for Canada. So, again, like, but the fact that we're below those, like, again, that would illustrate to me that we aren't really in a cause for concern. My fear is that there's probably this little bit of an artificial suppression going on where you have this like Canada Mortgage Charter, which we've done a whole episode on the show. Again, like you can call lenders, big six lenders with financial stress and stuff like that. And there's a lot more accommodation mechanisms for homeowners today than there was during the GFC and during the 1990s downturn. But to me, the trend is what we need to watch, right? If this gradual rise continues, and it could for a long period of time, especially as you have more people rolling over to more expensive debt, especially with so many mortgages up for renewal at higher rates in 2025, we could see these numbers climb even further. And that's why we really want to compare to the pre-pandemic environment, where what were rates during that period of time?
Yeah, so let's put some of these rates into perspective by, using some of that historical data we have. So we'll compare them to historical levels and pre-pandemic benchmarks.
Yeah, so as of November 2024, the Bank of Canada's policy rate stands at 5%, which is significantly higher than the pre-pandemic rate of 1.75 in January 2020. And sorry, that's your fixed mortgage rate, not your Bank of Canada policy rate.
Yeah, exactly. And if we look back even further, we haven't seen rates this high since the year 2001. Now, during the 2008 financial crisis, rates dropped to then a record low of 0.25, where they then stayed there until the mid 2010s.
Yeah, so, and then during COVID, we went to that 0.25 or the 25 basis point, basically 0% rates. And now then we went up to 5%, and now we're back at a 3.75% overnight rate. So 125 basis points from cuts there. And it's worth noting again, like going back, because CMHC obviously has like a lifetime of data on this. In the 1980s, we saw rates as high as 21% during periods of extreme inflation. So while today's rates feel high to many, they're not unprecedented in the broader historical context. And honestly, like we're pretty much like right on what the historical average is. I think the historical average rate is like a 4.11%, and I think your 5-year fixed rates are kind of in a comparable environment in like the fours.
Yeah, that's exactly right, Dan. The average 5-year fixed mortgage rate today is around 4.5%, and compared that to 2.5% in early 2020. This increase represents a significant jump, of course, for borrowing costs for any homeowner, which most of you listening are well aware of, because it's one of the major complaints we've been hearing for a few years now.
Yeah, and so that comparison really highlights why so many homeowners already are feeling the pinch and why so many more could potentially feel the pinch. And maybe the Bank of Canada is incentivized to get rates a little bit lower by the time we get to that renewal wall, as a lot of people are calling it. So to kind of lessen the burden, lessen the financial stress that could happen as a result of that million plus renewals over the next year and even into 2026.
Yeah, so let's talk about some of the biggest concerns that CMHC highlighted in this report. One of them being Canada's elevated household debt levels. Dan, this has come up multiple times on the show over the last several years. And for instance, like for every dollar Canadian makes, we owe $1.84 or 87, I believe. This is not a minor issue that can kind of be swept under the rug or kicked down the road. It's significant vulnerability for every Canadian and for our housing finance system as a whole.
Yeah, so as you mentioned, like that 1.8% or 1.8 dollars owed for every dollar made, or 180% debt to income ratio, gives Canada the highest debt to disposable income ratio of any G7 country. Higher than the US and Germany, which were both around 100%. And even like 100% to me is kind of like,
it's basically just a wash at that point, right?
Yeah. Well, it just means that like most people need to work an entire year and spend no money just to get out of debt. So I guess the scary part is like for every dollar that somebody makes, they owe 180 in debt. Right.
Pretty messed up when you think about it. And of course, with interest rates at their current levels, the cost of servicing this debt has skyrocketed, making it even harder to pay off that debt. And the debt service ratio, which measures the proportion of income used to pay interest and principal on said debt, has again climbed to nearly 15%.
Yeah, so to put that into perspective, this would mean that the average Canadian household is spending about 15 cents out of every dollar earned just to service their debt. This leaves less money for other expenses and savings, which are necessary for an economy to grow. And that creates a bit of a precarious financial situation for many people, but also for the economy as a whole if you add all of said people together.
Yeah, and the impact of this high debt load is far reaching. Now, on an individual level, it means households are living paycheck to paycheck. And that doesn't just mean the lower income or starting out kind of thing. This goes for higher income people as well. And unfortunately that leaves little buffer for any unexpected expenses, right? Even something happens with the car or some health issue or whatever it may be, right? So a roof goes, something with your house happens. And then that's just like on an individual basis. Let's look at a broader scale. What happens if we have a big economic shock, something happens and people are living in paycheck to paycheck? It just puts people in a really tough situation.
Yeah, I mean, this is where, and again, like CMHC mentions this in the report, these high debt levels make the economy more vulnerable to economic downturns. So, you know, right now, the biggest thing that I think most economists are paying attention to in Canada is unemployment. And if you start seeing a significant rise in unemployment or a sharp drop in housing prices or the stock market or something like that, where you see wealth destruction happen pretty quickly, which isn't unheard of in times like these, especially like with the stock market absolutely ripping and unemployment rising in Canada and the economy not doing exceptionally well, um, because so many people have so much debt and they're probably living paycheck to paycheck, making those minimum payments. You're seeing delinquencies rising. Again, not everyone, but enough people that
Hmm.
can cause a really, scary wave of defaults, which leads to foreclosures and more stress, like where it just is a negative feedback loop, right?
Yeah, we don't like that negative feedback loop idea. So when we look ahead to 2025, this high debt load combined with potentially higher interest rates could lead to increased financial stress for many Canadians across the country. It might result in reduced consumer spending, which would have an overall slowdown effect on the economy and economic growth, right? People aren't spending money. Everyone's being a little more cautious. You're living paycheck to paycheck. You're trying to save every dollar you can to not only pay off that debt, but to prepare for those emergencies. Well, then people stop going out and buying things and spending money in the economy. Hence why we've seen less employment and issues in that sector, hence that negative feedback loop that you were just talking about, Dan.
Yeah, and for the real estate market specifically, we might see more forced sales if homeowners struggle to keep up with mortgage payments, and that could potentially put downward pressure on home prices in some markets, which is great if you're an investor sitting on the sidelines in acquisition mode or waiting to buy your house. But it sucks for, again, the majority of Canadians, 66% of Canadians who own their houses already, or investors who already own properties who obviously have an incentive for those values to stay up. Maybe we're thinking about refinancing or whatever.
Yeah.
So it's a bit of a double-edged sword in that regard.
For sure. It is double-edged sword, and overall it's a very complex situation that kind of underscores the importance of responsible borrowing and the need for policies to promote financial stability, right? Let's really hone in on that term, responsible borrowing, which was completely ignored, I think, for a few years by a large portion of our two industries, Dan, and by large, I think greed got the better of a lot of people. So as we move into 2025, it's crucial for both policymakers and all of you, the individual Canadians that listen to this show, to keep a close eye on these debt levels and to take steps, whatever they may be, to mitigate those risks.
Yeah. So maybe let's just personalize this a little bit.
Oh, I like
And let's
it.
break down, let's break down how this vulnerability that we're describing could impact both individual households and broader economic stability as we head into 2025. And
Okay,
a lot of
maybe
these are
maybe I
based
don't
on
like
kind
it so
of,
much actually.
yeah. Well, it's worth thinking about. Like, again, not like, we don't want to be doomsayers or whatever, but, like it's worth, look, the best case scenario is everything recovers, everything's good. We don't need a plan for that. That's like, if it's the best case scenario, then
Best. There we
everything's
go.
rosy.
Giddy
Yeah,
up,
we're good.
baby.
You
Yeah.
don't need a plan. So let's think about what downside risks exist. And this is, again, based on CMHC's research, to see, okay, do I need to manage this? Do I need to recalibrate my portfolio a bit? Is there an opportunity here? Maybe I want to start, piling up some dry powder to make some acquisitions because I'm seeing opportunity. I'm seeing some risk ahead and maybe some better deals ahead, right? So
Yeah.
starting with,
Speaking of dry powder, sorry, Dave, but dry powder. I don't know if you saw it today, but I think Warren Buffett and Berkshire Hathaway posted they've got now more dry powder, aka cash, waiting to be deployed on the sidelines than ever before,
yeah, I think it's
which
like the
is
biggest cash position anyone's ever
ever
had.
had.
And
Yeah.
then there's
Yeah.
and there's like that Buffett indicator like chart. So, and it basically warns that, like, it's basically just flashing red, right? It just
Yeah.
would show that it's a valuation multiple used to assess basically how expensive or cheap the aggregate stock market is based on Buffett-esque fundamentals. So I would call that probably a pretty decent
Guy knows a
underwriting
thing or
metric.
two. Yeah.
Yeah.
Yeah. So anyway, sorry. Back to
No, yeah,
the
it's all good.
financial stresses here.
Yeah, so I'll start with the individual households and then you can kind of dive into the broader economy. So, look, the impact could be significant for individual households. Many families could find themselves allocating a larger portion of their income to mortgage payments, which leaves less for other essential savings. And so, again, if you're planning on saving more money or taking a vacation or whatever, just keep that in mind. Like, really think about today for your household budget for the next year. How much more money am I going to be spending on interest when I have to renew in 2025 versus my current rate? um, that would lead to reduced spending, right? Financial squeeze could lead to decreased consumer spending, affecting local businesses. So that's kind of the knock-on effect, and then that would slow economic growth. And amplifying that is the fact that we're going to see a decrease in Canadian population growth. And apparently, the government says they're going to decrease the Canadian population in its entirety, which I don't think they'll actually be capable of executing. So I don't know if we necessarily need to worry about that one.
Maybe don't
Um,
use decreasing population and executing in the same sentence. I might.
so the next kind of phase that would happen is your forced sales, right? So in more extreme cases, some homeowners might, or investors, and you're starting to see this, like I've been chronicling the power of sale trend for a long time.
Mhm.
And, you could see massive increases in power of sales. So, some homeowners might be forced to sell properties if they can't keep up with the higher payments. So I don't think that trend that I mentioned in power of sales, imagine like all of the people, you have a much smaller portion renewing mortgages today than you do or in in 2024 than you do in 2025. Now in 2025 they might be renewing at slightly lower rates because the Bank of Canada has put some work in between now and then, but you're just going to get more people. You have a higher volume of people now exposed to this financial stress and reduced spending, and that could potentially increase the amount of inventory on the market. And then you also just get, and that's like if the bank actually has to force a sale, through a power of sale or foreclosure process. There's also just non-forced sales. So there's a potential from pent up supply from people who can't afford to hang on. I mean, statistically, like especially if everybody who bought in the COVID era rates was buying with a fixed mortgage, because anybody variable has already been impacted by it. But so anyone fixed, statistically, they're most likely to sell when they're on up for renewal, right? Because then they don't have to pay their penalty, et cetera. Like if you're in a
Mhm.
fixed rate, there's costs associated with selling. And so it would not be unheard of to imagine like some of those people might just be waiting for that because they've said, prices are kind of stable. I don't think my property is going to go down that much in value. So I'll just wait and I'll sell it when I'm up for renewal so I don't have to pay that penalty. So there is a potential for a pent up supply from people who can't afford to hang on. So I think, like, to me, those are really the summary of the risks, the downside risks that, an investor could potentially capitalize on:
Yeah.
financial stress, reduced spending, forced sales, and potential pent up supply.
Yeah, and I like you have like you kind of put like the non-forced sales. I'd almost call them like soft forced sales, right? Those aren't. It's not the bank being like, "Hey, you got to sell this because you can't afford it," but it's people coming to the harsh reality themselves. And I've had a lot of these unfortunate conversations recently. People bought something, I'm just totally random numbers, but they bought something for 650. At one point it was worth 900, and it's kind of got back down to that 650, 700 mark. And over the years, at one point they could have made $250,000 on it. And now when they're planning on selling it because, they're essentially being soft forced to, they're not going to white knuckle through it for whatever reason that may be. They're really only looking at a little bit of a lift, if any, after you've paid out your commissions and land transfer and all that kind of stuff. Right. So, anyways, well said, Dan. Crucial points for individuals, but let's look at how this could affect the broader economy and overall economic stability. So let's start with the housing market. Volatility is a word that has been used to describe it for several years now, and I will use it again. And if we see significant number of forced sales that you mentioned, it could lead to downward pressure on home prices, which could potentially trigger a broader economic correction. Outside of the housing market, let's look at the banking sector, right? We only have 6 big banks here. An increase in mortgage defaults could put stress on those big banks, potentially leading to tighter lending standards, which we've already seen, and reduced credit availability, which we already seen. Now, is this just going to be exacerbated as these statistics get worse? Plus, add those two together, housing market and banking sector, and we could be looking at an overall economic slowdown, reduced consumer spending, combined with potential instability in the housing and banking sectors. This could contribute to an overall economic slowdown.